Help me solve this mystery. I'm going to fire in the chart here of Shanghai silver price in dollars. As I'm looking now, there is a $30 spread.
Mhm.
Michael, what in the world is going on here? Why?
Well,
Why?
we we know the Chinese want silver. We know they want it as an industrial metal in particular. The Indians want it as a monetary metal. In fact, they're remonetizing silver as money. They've already done it. But China is the world's biggest producer of solar cells. And throughout the developing world, solar panels are very important because you don't have a local power plant, and you were a rural community in Africa or in South America somewhere. So therefore, having your own solar panel is essential for you to have your cell phone and all kinds of other things. And the Chinese have capitalized on that market. They produce like 80–90% of that. And it's essential to have silver in the, forget what they call the tubes if going to the solar panels and photovoltaic cells. Also, silver is essential in the AI industry and the expansion we're hearing about. It's here, there, and everywhere in high tech. Little bits, but everywhere. And therefore, it's not recycled either because it's there in small amounts and it's never worth recycling. So once it's gone, it's gone. You know what I mean? Demand there is overwhelming supply in both those categories.
Yep.
And it's not been satisfied for 5 years, and it's not being satisfied this year in terms of supply meeting demand. So that's why China probably has a premium. Plus, I think they've banned exports of silver. And once they get it in there, it stays
Mhm.
there. So that could explain that. But that is not really the be all and end all of what this is about. The be all, and the silver's a surfer, and he's riding on two waves. Now, right now, everybody knows about the industrial supply demand deficit. That's been made clear to investors. And so, and the China situation. But it's money. It's also the baby of gold. 3,000 years it's been that. Don't dismiss it. And when the world gets
Yeah.
shaken by this and that other event, like the decline in the dollar's reserve status versus other fiats, the questionable nature of U.S. government bonds, and especially Japanese bonds or UK bonds, these are crises bubbling on the edge. And the monetary metals know that. And they're not going to wait for the event to happen in this category or that category. They're already building in their anticipation of those events aren't going away. It's just a matter of when do they burst.
Exactly. And I want to get back to that point. When do they burst?
Yeah.
But I just think that, just to wrap on that Shanghai chart, it just is perfect proof why precious metals are meant to be held and not flipped. And also, Michael, any thoughts on some bullion dealers currently, because of the amount of physical silver entering the market, some are telling their clients they may receive approximately $10 to $15 per ounce below the spot price.
No opinion on that issue. These supply-demand unique issues will pop up all along the way on the sidelines. Just like changes, for example, a lot of traders like to look at futures trading data, like commitment of traders or short positions and so forth. And all these things will come and go, and there'll be exciting points, or they might be negative points from time to time. But really, they're not part of the big process. And the big process is there's two waves that silver's on. One is the industrial one, but it's the money. That's the bigger wave underneath the monetary metals. And so silver's got, it's a double-barreled situation, whereas gold is unibarreled, okay? It's the money metal. But all these little factors that we can cite day to day that pop up as headlines or data points. Yeah, they're interesting, and some will be negative and some will be positive, but they're effectively noise in a much bigger situation.
And let's talk about that bigger situation. We can wrap here because the last time you opened our eyes or really pointed to the dollar breakdown, the treasury bond market as major turbochargers, and pointed to that bringing us close to the real panic. And you were also waiting for the Supreme Court hearing on tariffs. And here we are, still waiting, Michael.
Well, let's look at all three. First off, the dollar.
Yeah.
The dollar is a constant piece of decay anyway. Look at M2, you can see how much supply increases every decade, like 80, 90% supply increase. Therefore, its real buying power continues to collapse decade by decade. That's true with the euro and the yen. Okay, so when you compete those pieces of fiat with each other, the technicals right now indicate, the dollar's going down. Now, right now it's struggling to hold, but it's already broken long-term momentum trends. And the price trend is also now in jeopardy, where anybody looking at a price chart going back to 2010 on the dollar index says, oops, we're below the line. Okay, that's one factor. It's not I consider that actually lesser of the fundamentals, the relative value of the US dollar versus the euro or the yen, which is what the dollar index is basically. The other one is the government bond market. We know we have a crisis building there, even in the U.S. Jamie Dimon said that months ago. You can't keep pushing this down the road. Ultimately, it'll resolve in some noisy way if you don't take care of it. And of course, it can't be taken care of very easily, if at all. The Japanese have demonstrated that. They're in crisis mode. They're trying to put out fires. Well, and we also know this is true with like the UK and so forth. So it's not just one country in the West. Consider Japan part of the West here. We know they're all in trouble. Government debt too. The average citizen out there who used to feel comfortable putting money into government debt, if he has doubt about that, whoa, that's like a nuclear event. I mean, where do you put your money? It used to be the alternative, the place to, bank it safely. And if that's in question, foreign investors in U.S. bonds, if that's in question, or U.S. citizens buying bonds, then the Fed has to buy them. And sure enough, that's what they said they would do in November, and they've been doing it. You can look at a bond futures chart, and you can see, though they've been buying it, it's come down, yields have gone up a bit, and the stranglehold of high yields on the long end, like 30-year bonds, remains at a high level, despite the Fed cutting short rates. That's choking commercial real estate. It's probably also having pressure on some debt markets that banks hold, okay? Some corporations that are big in debt, and the long end of the market's what's killing them. So the Feds have been buying bonds since November, and yet there's no upside in the bonds. There's still downside. Higher yields, lower price. You drop the bonds about 3 to 4 points. Where we're trading right now is about 115 on the bond futures, 115. You really don't want to get it down into the 112s again. Okay, now recent lows have been in the 113s about a week ago. Okay, you don't want to get down in the 112s again. If you do, our technicals say that this holding pattern we've had on the price of bonds after the collapse in 2022, or the jump in yields in 2022, is stalled. It won't stall anymore if you slip about 3 more points below where you are now in the bonds. You'll start to puke. And that could potentially create an event where suddenly the U.S. starts to look like Japan. You can't have
Wow.
That can't happen. Okay. Anything else doesn't matter almost. Okay. So we've got the dollar. We've got the bond market. Now we have an asset class shift going on with the commodities. Just what the government doesn't want, and what President Trump said wouldn't happen, especially with gasoline prices. We're arguing that what happened last month at the close of crude oil was a breakout on long-term momentum that said, hey, the quietude you've seen in this market for a couple of years now, the slow depression in prices, it's over. We're going back up again, and we don't need an excuse. Cheapness alone is an excuse. And so if you have the commodity asset category, which is also broken out, the Bloomberg Commodity Index, and oil's now joined in, and wheat also joined in with last month's close by our metrics, you got a problem there. Because all of a sudden then, the average consumer who is already in somewhat of a stranglehold, day-to-day cost of living, if you suddenly take his gasoline prices up about 50%, which I could see happening within a quarter or two, $60 to 90 crude, and 90 crude isn't even expensive. Remember, we were 130 in 2022. That's a 50% jump in your gasoline prices. All of a sudden, doubt hits the average guy pumping that gas, and also his stranglehold by the daily consumption of goods and services. And they're already hurting. Imagine if the commodity complex jumps 20, 30, 40%. It's still cheap, by the way, at that level. That's another major factor out there that totally upsets all norms. And what? It also provides backwind validation of what the monetary metals have already been telling us.
That's
There's something
right.
going on here. There's a major asset class shift, and it's not over.
100%.
You don't break commodities out of a massive momentum base and break oil out and break wheat out and bonds in jeopardy, and that's the top in gold. Okay, that ain't the way it works. Look at the context. Don't just look at gold and silver. Look at the broader context.
100%. Michael, thank you so much for this touch base with us. Nothing has changed in terms of this forecast for silver, and for gold. You were eyeing, was it 8,000?
Well, 8,500 is an actual normal bull market for gold. It's an eightfold move from its bare low, 2015 low at $1,050 to 8,500. That matches the same dimension move, multiple gain, that occurred at the 1980 peak and at the 2011 peak in gold. So gold is only a five-fold move. Those two moves are eightfold.
Within this year.
Yeah, and by the way, J.P. Morgan has suddenly come out with the exact same number in the last few weeks. They came out with a target of 8,000 to 8,500. Curious. Anyway, so even one of the big banks now agrees with what MSA's been saying for a couple of years. And by the way, that's not our target. That's just saying, hey, if we get there, you've done it again. Something you've done twice before in the last 50 years. So it's hardly a big achievement. We don't think it'll stop.
What's the major? What's your target then?
I don't have a target. I do have a ballpark on silver, but I don't have one on gold.
What's the ballpark on silver?
Well, again, I think it's 300 to 500 this year.
Right.
And
Okay.
probably
okay.
much of that by summer. Gold, I don't have a specific target except to say that if you went to 8,500, big deal. You've done it twice before.
Okay. So is this a correct statement? You wouldn't be shocked if gold hit 8,500 in 2026.
Oh no, yeah, absolutely. Yeah, no, that would I would expect that. But again, I wouldn't call that a projected top. I would just say it's done it twice before. Eightfold move.
I heard. Okay.
So
I hear you.
it's
Wanted
a
to just
ho-hum move.
clarify that.